Thank you so much for joining us tonight to continue to develop your financial confidence strategy. I am Lynn Demmons, one of your hosts tonight, and our second host is Nakia Cook from Everything Kia. And we have some exciting information to share with you tonight on accumulating your assets. So as we get started tonight, I just wanted to set the tone or set the stage, if you will, with the millionaire mind. There are some things that are very important for us to keep in mind as we progress through this process. And the quote that I want to share with you is listed here on the screen, is that millionaires become millionaires in part because they've learned to say no. They have the discipline to turn down good so they can pursue and achieve the great. And I want you to think about this quote as we move throughout the information tonight. And think about what this means to you. How have you thought about the different things that we'll be positioning to you? And how are you setting yourself up to move to that next level to be able to accumulate assets? So in looking at how to accumulate assets, one of the things that we want to start out with tonight is looking at how the wealthy invest. If you pay particular attention to this graphic that's on the screen, it basically talks about the asset mix of the top 1%, which are the wealthiest people, compared to the next 19%, and then finally the middle class, or the next 60%, if you will. In looking at this graphic, if you look at the pie charts, you'll see the different pieces of the pie, and they all have different colors. And there's a key here on the graphic that basically tells you what those colors represent. So the blue you see here is your principal residence. And if we compare the principal residence of the middle class, that middle 60%, our principal residence is 63% of our wealth, if you will. 63% of our wealth. But when we compare that to the next 19%, if they're looking at their home, their principal residence, that's only 28% of their total wealth accumulation. And the top 1%, their home or their principal residence represents only 9% of their total wealth picture. So looking at this gives us a different insight, right, into how the truly wealthy are utilizing other resources. And what I would like for you to pay particular attention to, we focused on the blue, but I also want you to focus on the reds in each of these graphics. The reds for the top 1%, the majority of their wealth is located within opportunities for business equity and other real estate ventures in which they've taken a part in. However, for the middle class, that's only representing 9% of the pie for us. So there are many opportunities for us, and I've only focused on those two, your principal residence or business equity and other real estate, but there are so many different things that come into account, whether you have a pension account or a 401k, those retirement accounts. Do you have financial securities or other liquid assets or monies that you can readily get your hands on in a short period of time? So tonight what we want to do is start thinking about not simply investing, and if you don't invest, we implore you to begin investing today. However, if you don't, think about some of those things that you can start doing now. But ultimately, how can we get to that asset mix of the wealthy? How can we build so that our primary residence isn't the largest portion of our wealth? We have some other opportunities within our asset mix to grow. So in looking at our information tonight, so we'll start and set the stage by talking about a good asset accumulation. So what are those good assets? What are those things that are going to increase your net worth in general? And that's key for us. Do you know your net worth? If you don't know your net worth, I highly suggest or recommend that you find out what that is. What are your assets? What are your liabilities? If you subtract those and your liabilities outweigh your assets, then you have a negative net worth. So tracking your net worth is very important in determining your asset accumulation or your abilities to be able to do that. So some examples are listed here on the screen as well. Maxing out your 401k or your individual retirement accounts that you may have through your companies, or owning your own home or townhome or whatever that principal residence is that you live in. Do you have additional income producing real estate, or have you considered that, or you're interested in doing that? Those are all good assets to have, as well as owning a business. Do you own your own business? Because in this day and age, there's an opportunity for everyone to get a different piece of the pie, if you will. So in looking at this, I wanted to start out tonight by talking about compound interest. We always hear this phrase, compound interest is your friend. And it absolutely is, because compound interest is a way that your money grows. If you think, for example, I want to put back $100 a month. And if you're able to put back that $100 a month and invest it at 8% or 12% interest every month, and you start before you're 30 years old, you're almost guaranteed to be a millionaire, right, by the time you retire. So looking at compound interest, we always look into the rule of 72. How long will it take your money to double, depending upon the amount of money that you have to invest now and the amount of monies that you will continue to invest for the long term? So, and we'll talk about a lot of those different things tonight as we progress through the information. One of the other things that I wanted to focus on, and this is a great activity for sharing with your kids. This activity, you set up the scenario where you tell your child they own a business and they're going to pay this person 1 cent to start out, but they have to double their income each day for 30 days. So you ask the person, do you want that money, 1 cent, starting out with 1 cent, and double it for 30 days? Or would you prefer just to have $100,000? Okay. If you do not do the math, you do not know this rule of 72, if you will, then you are more likely to choose the $100,000 scenario. However, if you can look at this picture here, you can see how the monies are progressing from day to day. We start out at 1 cent, 2 cent, 4 cent, 8 cent. It's growing slowly. But by the time we get to day 18, day 19, we see things start to progress. Day 18, there's 1,310. By day 25, we're already at 167,000. So absolutely, compound interest is your friend. And one of the things we'll talk about tonight is long-term investing, and why long-term investing is typically the best way for new investors, or those of you who are new to accumulating assets, is the best way for you to grow in this arena. But as we talk about growing, I also want to share with you that over the course of your life, you will have to interact with so many different professionals to help you throughout this financial field, if you will. And your financial team is very important. It's important to work with people you trust, people who are reputable. They are established professionals within any given field. So make sure that these people, these individuals you are working with, have your best interest, not theirs, in mind. Because if you think about it, many of the financial planners, investment bankers, realtors, loan officers, all of those guys typically work on commission. And that means that they don't always have your best interest, or they don't always give you the best advice, because they have something to gain from that relationship. So you should build a team that includes a lot of different professionals, whether that's a financial mentor. And a mentor is typically someone who is going to give you advice. You feel comfortable reaching out to this person, but you never take anyone's advice without doing your homework. Do your own homework. You're looking for a guide to help you along this way. You're not looking for a puppet master. You don't want someone to say, you must do this. You have to make those decisions. Do your own research as backup, because maybe one day you'll become that financial mentor to someone. You never know. But make sure that you take advantage of the opportunity, yes, to have that trusted person that you call on, but do your own homework. Another example of in this team, your tax planner. Tax day was just a few days away for many of us. Making sure that you have the right tax person or tax planner on your team will help you to keep more money in your pocket. Because if you think about it, the tax code, if you ever research the tax code in general, there's over 17,000 pages worth of material. So it's very important to have a tax planning professional. It's, dare I say, critical to you to have this person on your team. For those of you with children who are planning to go to college, you need to find someone who's a talented college planner, because they can help you with the scholarship dollars and connect you to determine whether or not this cost is going to be worth it for your child if they're earning a potential degree. And there are different opportunities for you to maximize this relationship. The other example I wanted to pull out here is your financial advisor or your financial coach, which is the role in which I serve. And in looking at your financial coach, this is usually a person who can help you achieve those financial objectives that you have. You make sure you have one of these individuals on your investment team. So find someone, though, who believes in furthering your education or their education, and they take the time to truly understand your investment objectives. So what's important to you is going to be the key here when working with your financial advisor or your financial coach. It also mentions insurance agents as part of your team. They are typically important, but most people tend to choose an insurance company because they can get the cheapest rate with that company. But sometimes that can turn around to bite you. It can also, it might actually cost you more in the long run if you're choosing them simply because it's a cheap alternative. Just make sure that you're working with an experienced agent who can address, your unique situation in that case. And of course, a realtor or mortgage professionals. For those of you who've gone through this process, you own your own home, or if you're planning to purchase a home in the near future, it is invaluable to have that expert assistance of a realtor or that mortgage professional, because they can help you do a lot of those things. Yes, there are some calculators on websites that you can go to for free where you can actually calculate, what will be my principal, what's the PMI, how much interest am I going to have to pay. But actually having that mortgage professional, that realtor on your team is invaluable, because they help you in not only getting that financing that you need, but researching and finding the perfect property for your needs within your financial capabilities. So if you are planning to buy a home in the next few years, you want to start early and find a realtor who's going to be there to help you in your best interest. And with these financial decisions that you're making, it's best never to rush. So early planning is definitely a good idea as you're progressing, and just simply find someone who's willing to work with you now and help you prepare. That's the sign of someone that you can trust. And I also wanted to give you a couple of questions that you may want to write down when you're in the search of this, when you're looking for this trusted advisor to help you on this path. The types of questions, basic questions that you should be asking them is, how long have you been doing this? How long have you been in this respective field? What are your fees? How do you get paid? Those are very important questions. Another important question is, what are your credentials or certifications that you've completed? Not only having credentials or going to school, but Have there been any disciplinary actions that get taken against you? So having that information in your back pocket will help you to determine whether or not these are the individuals or the people that you want to have on your team. Okay, so you want to find someone who's going to give you the best possible advice that's going to be fitting for you in your situation. Why am I honing in on this so much? You don't want to rely entirely on one financial advisor for everything, because in each of the different areas, there are experts. So find the expert in that particular area. So tonight, as we look at the different types of investments, we talk about accumulating assets. There are different ways to do that. Some of your more traditional ways would be through your savings accounts, your CDs, and things of that nature. Just wanted to give a couple of terms that are very important when we're talking about these items as well. What will be the return for you? What's the return on your investment? What are some of your benefits? Know the risk. And how liquid are those assets? And by liquid, I mean, how quickly can you get your hands on your money, right? Typically with a savings account, a CD, there's not much of a problem getting your hands on your money if you think in those terms. But there's typically low cost to access your money. Now with the CD, be reminded that if you do sell the CD before the maturity date, you will probably pay some penalties, but more than likely you'll be able to access that money with minimal or no problems to get that. The annuity, oftentimes the returns on annuities vary, and I definitely say to you, this is one place where you must do your research. There are so many benefits with annuities. They include the potential to generate a future income stream, so you can get paid over time, but some offer capital protection as well. But there are also some risks that are involved with annuities, and that varies with the different type of annuity that you may have acquired. So it's very important to know the particular product or the investment that you are working with. And as far as liquidity for annuities, most annuities allow for some type of distribution penalty free, but you won't be able to access all of your money immediately without paying those penalties for annuities. So for me personally, I tend to steer clear of annuities, but some of the other things that I like that have worked well for me have been in the investments of some individual stocks, looking at mutual funds, commodities, and exchange traded funds. These are opportunities here that you can definitely grow your net worth. In looking at individual stocks, let me first just say this. For the stock market in general, if you buy a stock, that basically means that you're buying a portion of that company. You own a piece of that company in buying a stock. So the returns will vary depending upon the market conditions and the different investment strategies that you may be using. So there are tons of benefits because you know stocks can have the potential to earn a lot in as far as returns, and those returns can be greater than the rate of inflation. But the risk here is you can lose 100% of your money. So you definitely need to do your research when we're talking about these areas of stocks. But as far as the liquidity of individual stocks, you can sell those stocks anytime the market is open. So your stocks can be traded after hours as well, but you need to make sure you do the research prior to doing that. What a lot of people individuals are accustomed to hearing about are mutual funds in many cases. If we look at the returns, those vary greatly for each of the different mutual fund investments that a person can make. There are so many different benefits that are available, but there's a wide selection of options that allow for that variety of whatever your investment goals happen to be. But what you need to know is that with some mutual funds, you can lose your entire capital investment. So you need to make sure that you are aware of what's going in and what's coming out, and whether or not you want to access the liquidity of your mutual fund. As far as the liquidity, and remember again, that means getting your money. Most mutual funds are liquid, right? And like shares, you can sell them the same time or the next day at what they call the net asset value. What is the value of it at that day and time that you are selling it so that you can get your money out? So there are different types of mutual fund classes that you can choose. But do know that some of those do carry a penalty, so you'll be penalized if you withdraw your money early from that particular mutual fund. And the one that I like, that I think that is has been a game changer for many, including Warren Buffett, and I love these myself, the exchange traded funds. The returns for exchange traded funds varies depending upon the type of fund that you choose. So again, I say this and I will continue to say, do your research as far as the funds are concerned. But with the ETFs, there's broad market exposure. What do I mean by that? You are investing in everything that's available in the market in that particular fund. As opposed to in an individual stock, you're only investing in Walmart, or you're only investing in Target. But in an exchange traded fund, you're investing in the entire stock market. So what do we typically see? Some things go up and some things go down, but not everything goes down at the same time. So that's one of the reasons that an exchange traded fund can be more highly lucrative for you. But I will share the risk. You can also lose some or all of your money in an exchange traded fund, even though it has not been as likely, but there is the risk there. But this also shares the highest degree of liquidity. Most ETFs, let me say that, most ETFs have a high degree of liquidity, so you will be able to get your hands on your funds quickly. One of the ones that I didn't mention, and I'm going to go through this quickly because I know that we are short on time, looking at bonds. Typically, bonds is the go-to for many. When we talk about the stock market, and the S&P 500 is where we can find this information. But the bonds are going to vary widely based on the type of bond that you are interested in. But the return on municipal bonds, and those are those you typically find within like your city or your county, those vary depending on the safety of the investment. But you can range from a 2% to 5% interest rate. Or the returns on a corporate bond, for example, can range from 4% to as high as 20%. So you have a variety of different types of bonds that you can invest in. These are typically less volatile, so you don't have the risk of losing your money as high as you would in stocks with bonds. So they're somewhat more secure, if you will. But if you choose a high-risk bond that's known as like a junk bond, those are typically issued, and the company that issues the debt, they go bankrupt, you could lose your entire investment. So it's very important to know the risk for your bond, but there's also the inflation risk. So you may have something inside of a bond that's at 2%, but inflation rises an additional percent to 3%. So you're losing that opportunity to gain that interest. And finally, for real estate, investing in real estate has many benefits. You know, you have the appreciation of your home, your property value basically is going up in value, or you have the potential tax benefits and leverage. So in good real estate markets, you can sell your home within a few months, right? But within a bad real estate market, like when we saw with the economic downturn of 2008, 2009, it takes several years for you to be able to sell your house, or you had to deeply discount your home to sell it. So the cost of a sale is about 8% of the home sales price, if you look at it from that result as far as liquidity of your home is concerned. So there are so many different opportunities for us to invest or different assets that we can accumulate to ensure that we have those investments. But I definitely wanted to also talk quickly about the approaches to trading, because we talked about individual stocks and mutual funds and ETFs and all of these different things, but there are different types of trading that people invest in the market. And you've all probably heard about like a day trader versus a short-term investor and a long-term investor. And I am going to say this quickly. We highly suggest and recommend, especially if you are new, you don't have the investment education, and until you build your education, it's probably best for you to focus on long-term investments. And that's your buy and hold strategy, essentially. Buy those stocks and hold it, and you're purchasing those stocks in hopes of generating large gains over a long period of time. Now, you can, invest in short-term opportunities like CDs, right? If that's something that you need, that it's for the short term, absolutely use a CD or something with less risk that's going to be able to provide some additional funds for you. But unless you're extremely experienced, it's wiser to adopt that long-term investor mentality. Okay, so in looking at this information, I am going to turn it over to Nakia for investing in real estate.
Just quickly, thank you, Lynn, for all that. That was great information. Just looking at the benefits of leverage, equity growth, tax benefits, appreciation, higher return on investment, and cash flow. I just want to hone in on some of the tax benefits that you get for real estate. When you go out, the government rewards rental property owners, such as the cash flow received from your rentals are not subject to self-employment tax. I thought that was very interesting. Although it may seem like it's not an enormous benefit when compared to other investments, it's significant when you compare it to your normal earned income. So for example, when you earn money at a normal salary job, you pay roughly 7.65%, and that's as of 2016, of your salary in FICA tax. So if you're self-employed, you would pay 15.3% towards the FICA tax. So very high level. Just say, for example, with $100,000 salary, that's $7,650 of your FICA that you will be paying, and $15,300 out of pocket for your salary. But if you earn that $100,000 of rental income, you avoid this tax completely. So there is a big incentive to start earning money from rental income. And another one is just that equity growth, which is capital growth. And that's an increase in value of an asset or investments over time. Now, some of the risk, as you can see, will be the liquidity, change in loan market, change and market conditions, as well as maintenance. And Lynn touched on a lot of those with the liquidity and such. However, I just do want to mention that with liquidity, a major risk will be the need to raise cash through the quick sale of property because of the change in investors' needs or objectives. So the likelihood of achieving the best price for a property through a rushed or forced sale is significantly less than it would be if you had time to find the right buyer or the right price. So there's a lot of up and downs and risks and benefits to having rental property. However, the tax benefits implications are the best when going into that. For the sake of time, to sum it up on the next slide, Lynn, we were going to talk about the importance of investment diversification. Now, it goes right into the beginning of that, playing right in the asset mixing that we discussed in the beginning of the webinar. Now, diversification is a technique that reduces the risk by allocating your money through all these various financial instruments, industries, and categories. So, although it doesn't guarantee against loss, like diversification is the most important component of reaching long-range financial goals. And as you can see, you have bonds, money market instruments, mutual funds, stock, real estate, and business that Lynn talked about and how we talked about previously through the past weeks. But I just want to give an example. Like, let's say you have a portfolio of airline stocks. So we all know in the news and things that happen with a particular airline. So let's say if the company publicly announced that the airline pilots are going on an indefinite strike, Now, all flights are canceled, so your share prices of airline stocks will drop and your portfolio will experience a noticeable drop in value. However, you can counterbalance that airline industry stock with a couple of railway stocks. So only a portion of your portfolio will be affected. And in that, it's a good chance that the railway stock prices will climb as passengers turn to trains as an alternative form of transportation. So it's a ton of information with investments. However, the bottom line is diversification can help you manage your risk and reduce the um, volatility of an asset's price movements. So remember that no matter how diverse your portfolio is, risk can never be eliminated completely. So you always, as Lynn mentioned, should check with different financial resources and your accountants as well. So you can reduce the risk associated with individual stocks by generally market risk affecting nearly every stock. So it's important that, as mentioned, that you diversify in several of those different asset classes. So the key is to find a medium between risk and return to ensure that you achieve your financial goals while while still getting a good night's rest. Because we all know that investments can be stressful, but we all want to know that as long as you have a good mix, you'll be able to just get on top of receiving financial freedom and that mindset of having money coming in your way. So back to you, Lynn.
Thank you, Nakia. And you hit on a couple of key points that I want to reiterate. Definitely investment diversification is key. But as far as a few important lessons that you want to recall, and make sure you write these down. Don't listen to hot stock tips. Because a lot of times you'll hear people say, oh, I have the hottest stock tip. This is going to blow up, right? And they're wrong, right? Those people move away, and that moves you away from your investment strategy in general, okay? So you've probably seen this in your inbox, in your email account. There's this bogus stock tip that has come in, and it's in your email spam account. And that's exactly where it belongs, in your junk folder. So don't listen to those hot stock tips. Another thing to note is, don't invest in individual stocks unless you are highly educated or you have a trusted team on your side, because it can be tricky. It can be tricky to pick out that winner. There are hundreds or thousands of stocks out there, and it's not for the faint of heart. And like Nakia said, we want to be able to sleep at night after we choose these stocks and not sit there and worry about, oh my gosh, my money's going down. Should I take it out? Oh my gosh, should I leave it in? What should I do? And the last thing I want to share is, be careful who you take advice from. This is very important information. This is, as you can tell, that Nakia and I, we are very passionate about this topic. And it is our purpose to ensure that we educate the masses as far as financial literacy is concerned. What we want to hone in on, and you've heard this over and over, whether that's on television, on the radio, Wall Street is full of conflicts, and everyone wants a piece of your money. What we're saying to you tonight is to keep your money in your pocket and make those wise decisions as far as your investments are concerned. So as we progress, and we're getting ready to close out for tonight, I just want to remind you of the Financial Confidence Strategy Oath. Tell yourself, repeat after me, I commit to achieving my goals to develop a financial confidence strategy by doing what? What will you do with the information that we've shared with you? What steps will you take to accumulate more assets? We thank you so much for joining us tonight. And this is your chance. If you are interested, if you want to take